Stop right there. Do not scroll past this, because what I'm about to tell you in the next few seconds could be the single most important financial moment of your entire retirement. If you were born before 1971, the IRS is holding your money right now, and they are never going to call you to come get it. This is not a joke. This is not a scam. This is not clickbait. This is a reality that is happening to millions of American seniors every single day, and most of them have absolutely no idea. I am talking about 5 specific IRS forms that are sitting on IRS.gov and SSA.gov right now, completely free, available to every qualifying senior in this country. But 95% of the people who qualify never file them because nobody told them they existed. And if you close this video right now, that money stays right where it is. It does not come to you. It stays in the system. But if you stay with me for the next 30 minutes, I'm going to walk you through every single one of these 5 forms, one at a time, in plain, everyday English. No confusion, no jargon, no complicated tax language, just straight talk about money that is already legally yours. And I need you to stay all the way until form number 5, because that one form alone, the one that almost no senior in America has ever heard of, could put more than $5,000 back in your pocket, starting as soon as next month. One form, 20 minutes to complete, $5,000. So right now, before we go any further, I want you to do one thing. Drop the word "ready" in the comments below. Just that one word, because the people who engage stay until form number 5, and form number 5 is where the real money is. Now, before I give you form number 1, I need to explain something that most people never think about, because once you understand this, everything else on this list is going to make a lot more sense. Why do almost nobody know about these 5 forms? Think about it for a second. The IRS is a passive system. They do not call you up and say, "Hey, you overpaid, come get your money back." They stay quiet. Because as long as you do not claim what is yours, that money stays exactly where it is, inside the system. Your CPA, your tax preparer, they do not automatically file these forms either, because these forms are not part of a standard return. Unless you specifically ask, they are not going to bring it up. There is no extra incentive for them to do so. Now, I want to be clear. This is not a conspiracy. This is not me saying the government is out to get you. This is simple economics. The system rewards the people who know how to work it, and it quietly holds on to the money of the people who do not. And here is the part that should make every senior watching this sit up straight. You worked for decades. You paid your taxes. You contributed to Social Security. You did everything right. And now in retirement, when you need that money more than ever, the system has never once told you about 5 forms that could put real dollars back in your pocket every single month. That is exactly why this video exists, to tell you what nobody else will. And the clock is ticking. June 30th is not a random date I picked. For several of these forms, if you miss that window, you are waiting an entire additional year to recover money that is already legally yours today. Before I go further, I have to be straightforward with you. This video is for educational purposes only. It is not personalized tax or legal advice. Tax laws are complex, and your situation is unique. Always consult a licensed CPA or enrolled agent before taking action on anything you hear today. Now, let me tell you about a couple from Arizona. Their names are Frank and Carol, both 67 years old, both retired, and last year a single form, one of the 5 I am about to show you, saved them more than $5,000 in 12 months, starting the very month after they filed it. They had never heard of this form before, their tax preparer had never mentioned it, and every single month before they filed it, they were paying money to the government that they never legally owed. I'm going to tell you their full story before this video is over, and when I do, I think you are going to understand exactly why I feel so strongly about getting this information out. All right, let us get into it. Form number 1. This is the single most ignored form in the entire IRS system, and it is the form that puts money back in your monthly check the fastest out of anything on this list. The form is called Form W4P. You can find it for free at IRS.gov right now. Here is what it does. When you receive distributions from a pension, an annuity, or an IRA, The pension administrator or IRA custodian withholds federal income tax from your payment before it ever hits your bank account. Every single month, they take a cut for taxes first and send you the rest. Now, here is where millions of seniors are getting quietly hurt every single month without realizing it. When most pension programs and IRA custodians set up that withholding, they use a default rate, and that default rate is almost always too high. Or they run a generic calculation that assumes you have more taxable income than you actually do. Because they do not know your full financial picture. They just plug in a number and go. So what ends up happening? Every month, they hold back more than you actually owe. You get less in your check than you should. And then in April, you get a refund. And most people feel pretty good about that refund. A little extra money coming back feels like a bonus. But here is what that refund is actually costing you. That was your money the entire time. Every dollar of that refund was a dollar that sat at the IRS for 12 months instead of sitting in your bank account. You gave the federal government an interest-free loan for a full year, and you got nothing for it. Let me put a real face on this. Meet Harold. He is 66 years old, single, lives in Georgia. He has a pension that pays him $38,000 a year. His custodian is automatically withholding 10% of every distribution. That is $3,800 a year being held back before Harold ever sees it. But here is the truth about Harold's actual tax situation. Because Harold is 65 or older, he qualifies for the additional standard deduction for seniors. Add in the new senior bonus deduction that went into effect, and his actual federal tax liability on that $38,000 pension income is somewhere around $1,400, not $3,800. That is a difference of $2,400. $2,400 that Harold is handing over to the government every single year for absolutely no reason. Money he never owed, gone from his pocket, sitting at the IRS until April. That works out to $200 every single month. $200 a month in groceries, in prescription medications, in utility bills, in anything Harold actually needs, just sitting there, waiting, when it should be in Harold's checking account right now. Form W-4P is exactly how Harold fixes this. He goes to IRS.gov, he downloads the form, he fills out the withholding worksheet, and he submits it to his pension administrator or his IRA custodian. And then here is the part I really need you to hear. The adjustment happens the very next month. Not next tax season, not next year, the very next month after the form is processed. That is how fast Form W-4P works once you file it. Now, I want to ask you something directly. Do you know right now how much federal tax is being withheld from your pension or your IRA distributions every month? Do you know if that number actually matches what you owe? Or have you just been trusting that whoever set it up got it right? If you are not sure, Form W-4P is your first step, and it costs you nothing to file it. All right, let us move to Form number 2. Form number 2 is for everyone who is collecting Social Security. And this is the form that determines whether the government is going to hold your money for a full year and give it back as a refund in April, or whether the right amount is going to show up in your account every single month the way it should. Here is something that catches a lot of seniors completely off guard. Social Security payments by default come to you with zero federal income tax withheld. Not 5%, not 10%, zero. Now, for some seniors, that is actually fine. If your total combined income is low enough that none of your Social Security benefit is taxable, then zero withholding is exactly where you want to be. But for millions of seniors born before 1971, people whose Social Security income is at least partially taxable, that zero withholding is a ticking clock. Every month that goes by with nothing withheld is another month of tax liability building up with nothing set aside to cover it. And then April comes, and suddenly there is a tax bill, sometimes a big one that nobody warned them about, one they had no way to plan for. And in some cases, on top of that bill, there is an underpayment penalty, extra money owed just because the withholding was wrong all year, all of it completely avoidable. with one form that most seniors have never heard of. That form is Form W-4V. Form W-4V lets you choose exactly how much federal income tax gets withheld from your Social Security check every month. You have four options and only four: 7%, 10%, 12%, or 22%. You pick the one that best matches your actual tax situation and submit the form. Now, I want you to understand this works in two directions, and both of them matter. Some seniors are under-withheld. Nothing is coming out every month, and April brings a bill they were not prepared for. That is a painful and stressful situation. Form W-4V fixes it. But here is the one that a lot of people do not think about. Some seniors are significantly over-withheld. They set up 22% withholding back when their income was much higher. Life changed. Income went down. But that 22% is still chugging along month after month, hundreds of dollars more than they actually owe going to the IRS every single month, while they struggle to cover everyday expenses. Let me give you Dorothy's story. Dorothy is 70 years old. She is married. She and her husband both collect Social Security. Their combined benefit is $34,000 a year. Several years back, when their income was higher, her husband set up 22% withholding on their Social Security payments. Fast forward to today. Their income is lower. Their deductions have changed. At their current income level, their actual effective tax rate on that Social Security income is closer to 9%, not 22%. They're overpaying by approximately $2,200 every single year. That is more than $180 every month that belongs in Dorothy's checking account. Money that should be covering groceries, prescription costs, the electric bill. Instead, it is sitting at the IRS doing nothing for Dorothy and her husband. One new Form W-4V fixes it. Submit it through the My Social Security account at SSA.gov. Mail it to your local Social Security office. Walk it in person. However works best for you. Once it is processed, your withholding adjusts going forward from that very month. Now, I mentioned at the top of this video that 2 of the 5 forms on this list were specifically designed for seniors, not for general taxpayers, not for working adults, specifically for people born before 1971 who are at or approaching the 65-year threshold. Form number 3 is one of those 2 forms. Form number 3. This form was built specifically for you. It is called Form 1040-SR. The IRS created it exclusively for taxpayers who are 65 years of age or older. And despite the fact that it has existed for years now, millions of seniors are still filing the regular 1040 every single year without any idea that a version built for their exact situation exists. Yes, the 1040-SR has larger print, and if you have ever tried to read a standard IRS form at 65 or 70 or 75 years old, you know exactly why that matters practically. But the print size is not the reason this form is on this list. The reason this form is on this list is what is built into the structure of the form itself. The 1040-SR has a dedicated built-in section for calculating the additional standard deduction that seniors 65 and older qualify for. It has a layout specifically designed around Social Security income and pension distributions, which are the 2 most common sources of income for people in your age group. And it includes built-in sections for the senior bonus deduction that many tax preparers and tax software programs simply do not flag automatically when they are processing a standard 1040. Here is the thing. You can technically claim everything you qualify for on the regular form. Nobody is saying you cannot. But the 1040-SR is engineered so that the deductions and income categories that matter most to your specific situation are right there in front of you, not buried in supplemental schedules and worksheets designed for taxpayers whose lives look completely different from yours. So here's what I want you to do. If you use a CPA or a professional tax preparer, ask them one specific question before you sign off on your return this year. Ask them, are you filing my return on Form 1040-SR? If the answer is no, ask why. If they cannot give you a clear and specific reason for choosing the regular 1040 instead, that is a conversation worth pushing on. If you file your own taxes using software, look for the option to switch to the 1040-SR before you hit Submit. Most of the major tax software programs out there support it. It may be labeled as the senior return, or it may be triggered automatically when you confirm in your profile that you are 65 or older. Either way, make sure the right form is being used for your return, because the whole point of the 1040-SR is to make sure you do not miss a single deduction you have already earned. And a reminder before we go further, everything I am sharing today is for educational purposes only. This is not personalized advice for your specific tax situation. Always work with a licensed CPA or enrolled agent who knows your numbers before you take any action. All right, form number 4. This one is the form that protects you from being taxed twice on the exact same dollar. And it is the one that retirees with IRAs are quietly losing tens of thousands of dollars to. Not because of anything illegal, not because of any complicated financial mistake, but simply because one number did not get tracked the way it should have been years ago. Here is the background you need to understand this. When most people contribute to an IRA during their working years, those contributions are tax deductible. You put money in, your taxable income goes down that year, and you pay the tax later when you take distributions in retirement. That is a traditional IRA. Simple, straightforward. But some people, particularly those whose income in certain years was above the IRS deductibility limits, made what are called non-deductible IRA contributions. They put after-tax money into the IRA, money they had already paid income tax on, money that should never be taxed again. Here is where the problem starts. If nobody tracks that after-tax amount, which the IRS calls your IRA basis, then when you start pulling distributions out in retirement, the IRS has no record that any of that money was already taxed. To them, every single dollar coming out of that IRA looks like pre-tax money, and they tax it again. You paid income tax on it when you earned it. Now you are paying income tax on it again when you withdraw it. The same dollar taxed twice, and you may have no idea it is happening. Let me show you exactly what this looks like in real numbers. Meet Robert. Over the course of his working life, Robert made $45,000 in non-deductible IRA contributions. He never consistently filed the form that tracks these contributions. Neither did the accountant he used during those years. Nobody caught it. Now Robert is 68 years old, and he is taking his required minimum distributions. His IRA custodian reports the full distribution as taxable income because there is no basis documentation on file with the IRS. Robert is being taxed on $45,000 that he already paid tax on once before. At a 22% federal tax rate, that is $9,900 in taxes Robert never legally owed. Gone. Unless he and his current accountant go back and fix it. The form that fixes it is Form 8606. Form 8606 is how you document your IRA basis with the IRS. You file it as part of your annual tax return for any year you make a non-deductible IRA contribution. And here is what most people do not realize. If you made past non-deductible contributions without ever filing Form 8606, you may be able to file amended returns to go back and establish that basis for the years those contributions were made. This form also becomes critically important if you have ever done a backdoor Roth conversion or if you are thinking about doing one. A backdoor Roth is when you contribute to a traditional IRA and then convert that contribution to a Roth IRA. Without Form 8606 documenting that the original contribution was non-deductible, the conversion looks fully taxable to the IRS. You end up paying tax on money that was already taxed. Again, if you have contributed to a traditional IRA at any point during your working life, and you are not 100% certain that every single one of those contributions was deductible, this is a conversation you need to have with your CPA before June 30th. Now, I told you at the very beginning of this video that form number 5 was the most powerful one on the list, the one with the highest dollar impact, the one almost no senior in America has ever heard of. We are here. But before I give you the form number, I need to explain something called IRMAA. Because without understanding IRMAA, The impact of this form does not fully click. IRMAA stands for Income-Related Monthly Adjustment Amount. In simple terms, it is a Medicare surcharge, an extra charge tacked on top of your regular Medicare Part B premium every single month. It applies to beneficiaries whose income crosses certain thresholds, and if you are paying it right now, it is costing you hundreds of dollars every single month on top of your regular premium. Here is how it works in 2026, based on information from the Centers for Medicare and Medicaid Services at CMS.gov. The standard Medicare Part B premium in 2026 is $185 per month for most beneficiaries. But if your income from your 2024 tax return, 2 years ago, exceeded certain levels, Medicare is charging you significantly more than that right now. For single filers, the IRMAA surcharge begins when your modified adjusted gross income exceeded $106,000. The first surcharge tier adds $74 per month to your premium. Higher income tiers push that surcharge up, all the way to $443 per month per person on top of the standard premium. For married couples filing jointly, those income thresholds are doubled, and the surcharge applies to each spouse separately, which means a married couple can be paying nearly $900 a month in IRMAA surcharges alone before a single dollar of their actual medical care is covered. Now here's the trap, and this is the part that gets retirees specifically. This is the part that almost nobody warns you about. Medicare does not look at what you make right now. It looks at what you made 2 years ago. Read that again. Medicare uses income from 2 years ago to set your premiums today. So here's what that means in real life. You retired in 2024. For the first 6 or 8 months of that year, you were still working. Your income was elevated. Maybe you also had a large IRA distribution. Maybe you took a pension lump sum payout. Maybe you sold a property. Whatever the reason, your 2024 income was higher than it is now. Medicare looked at that 2024 income, set your 2026 premiums based on it, and now here you are, living on Social Security and maybe a small pension, a fraction of what you made in 2024, and you are still being charged an IRMAA surcharge every single month based on income you no longer have, income you will never have again. Every month you pay that surcharge, you are paying for a financial situation that no longer exists. That is not right. And the Social Security Administration, which handles Medicare premium billing, actually built a specific correction mechanism into the system for exactly this situation. That correction is Form SSA-44. Form SSA-44 is called a life-changing event appeal. It is how you formally notify the Social Security Administration to stop using that old, outdated income figure and start using your actual current income instead. There are 8 qualifying life-changing events that make you eligible to file this form. Let me walk through all 8. Number 1 is marriage. Number 2 is divorce or annulment. Number 3 is the death of your spouse. Number 4, and pay attention here because this is the one that applies to most of the people watching this right now, is a work stoppage, retirement. That is it. You stopped working. That single fact alone qualifies you to file Form SSA-44. No other explanation needed. No complicated circumstances required. You retired. You qualify. Number 5 is a reduction in work hours that resulted in a reduction in income. Number 6 is the loss of income-producing property, like a rental property you no longer own. Number 7 is the loss of pension income. Number 8 is receipt of an employer settlement payment in a prior year that temporarily inflated your reported income. If any one of those 8 situations applies to you, since the income year Medicare is currently using to calculate your premiums, you may have the right to file Form SSA-44 and have your premiums recalculated based on your actual current income. Now let me tell you about Frank and Carol. This is the real Arizona story I promised you at the very beginning of this video. Frank and Carol are both 67 years old. They have been married for 41 years. Frank spent his career as an engineer. Carol worked for her local school district for over 30 years. Frank retired in June of 2024. Carol retired the following month in July of 2024. For the months they each worked in 2024 before retirement, their incomes were elevated. Frank's modified adjusted gross income for the 2024 tax year came in at $138,000. Carol's came in at $122,000. Because Medicare uses 2024 income to set 2026 premiums, both Frank and Carol got hit with IRMA surcharges when their Medicare bills arrived. Frank was placed in the second IRMA tier. His monthly Part B premium jumped by an extra $259.20 on top of the standard rate. Carol was placed in the first tier. Her premium increased by an extra $74 per month. Combined, Frank and Carol were paying more than $330 per month in IRMA surcharges, every single month, on top of their regular premiums. Now here is what their actual income looked like in 2026. Social Security for Frank, Social Security for Carol, plus a small pension from Carol's years with the school district. Combined income, $52,000 a year. They were being charged surcharges designed for people earning well over $100,000 a year, based on a year of income they earned 2 years ago, before they retired, and will never see again. Frank filed Form SSA-44. He checked the box for work stoppage. He attached documentation showing his actual projected 2026 income. Carol filed her own Form SSA-44. Same process, same documentation. The Social Security Administration reviewed both appeals. Frank's premium dropped back to the standard rate. Carol's premium dropped back to the standard rate. Their combined monthly savings came to more than $330 every month. Annualized, that is nearly $4,000 in premium savings for the year. And because they filed early in the calendar year, they were able to recover surcharges they had already paid going back to January. Total savings for Frank and Carol for that single year, more than $5,000. One form each, free to download at SSA.gov, 20 minutes to fill out per person, $5,000 back in their pocket, and they had never heard of this form before I told them about it. Form SSA-44 is available directly at SSA.gov right now. You can submit it online through your My Social Security account. You can mail it to your local Social Security office. You can walk it in person, or you can call the Social Security Administration directly at 1-800-772-1213 and request the form by phone. Once your appeal is approved, the correction typically takes effect within 1 to 2 billing cycles, and unlike many other appeals or adjustments, the correction can apply retroactively to months in the current year that you already paid at the higher rate. Most seniors never file this form, not because they do not qualify, because nobody told them it existed, you just found out. Now let me bring everything together. Here are all 5 forms in priority order, so you know exactly where to start and what to do before June 30th. If you are currently paying an IRMAA surcharge on your Medicare premium, start with Form SSA-44. The monthly dollar impact is the highest on this entire list, and the correction takes effect the fastest. Go to SSA.gov, file it today. If you are receiving monthly distributions from a pension or an IRA and you suspect your withholding is higher than what you actually owe, go to Form W-4P second. Download it at IRS.gov. Fill out the withholding worksheet. Submit it to your pension administrator or IRA custodian. Your next month's check will reflect the correction. If you are collecting Social Security and your withholding situation does not clearly match your current income level, Form W-4V is your third step. 4 options. Pick the rate that fits. Submit it to the Social Security Administration through SSA.gov or by mail or in person. Then confirm with whoever prepares your taxes, whether that is a CPA, a preparer, or yourself using software, that your return is being filed on Form 1040-SR and not the standard 1040. If you are 65 or older and that question has never been asked or answered, ask it before your next return is filed. And finally, if there is any part of your IRA history where you made contributions and you are not certain whether those contributions were deductible, bring up Form 8606 with your CPA as part of that same conversation. The window to go back and fix past undocumented basis may still be open, but it will not stay open indefinitely. Here is what ties all 5 of these forms together. Every single one of them already exists. The IRS accepts them. The Social Security Administration accepts them. Your money is already sitting there waiting. Form W-4P is on IRS.gov right now. Form W-4V is on SSA.gov right now. Form 1040-SR is in every major tax software platform right now. Form 8606 is legally required to be filed by anyone who has made non-deductible IRA contributions. Form SSA-44 has been available since the IRMAA system was created. Not one of these forms is automatic. Not one of them gets filed on your behalf without you taking action. The government does not send you a check for the appeal you forgot to file. Nobody mails you a refund for the form you did not know existed. The entire system works this way. Money stays exactly where it is until someone stands up and claims it. These 5 forms are how you stand up and claim what is already yours. You were born before 1971. You spent decades working, paying into the system, doing the right thing. The forms I just showed you are not loopholes. They are not tricks. They are not anything clever or complicated. They are the system working the way it was designed to work, for the people who know to use it. Now you know. One last thing before you go. Think of one person in your life who was born before 1971. A parent, a neighbor, a friend who retired last year, a sibling who just turned 65, someone who is almost certainly missing at least one of these 5 forms right now. Share this video with that one person, because one share from you could be worth thousands of dollars to someone who has absolutely no idea this information exists. This information reflects the 2026 tax year based on sources verified as of the current date. Tax laws change. Always consult a licensed CPA, enrolled agent, or qualified tax professional before taking action on your specific situation. Your numbers are unique and the details matter. If even one of these 5 forms was new information for you today, you now know something that could change your financial picture before June 30th. Do not wait. File the form. Claim what is yours.